This is Quent Bilo with introductory comments about the statement of cash flows. This is an important required financial statement, and in this talk we'll limit ourselves to an overview only, explaining why the report has 3 detailed sections to it, which correspond to repetitive activities businesses engage in. We'll look at a cash flow statement, we'll look at where the information comes from, but we'll save the details of its preparation until another talk. What's the purpose of a cash flow statement? Cash is one of the most important assets a company must manage. And so it's important to know how cash came into a business and how it was used. Those details speak volumes about how business is managed. The statement can give us a basis for predicting future cash flows, the ability of a company to pay dividends and other obligations. As mentioned, it's a required statement from a GAAP perspective. What it does not do, it does not help investors assess the entity's ability to generate future net income. We'll see that net income and cash flow are different due to timing reasons. This required statement will look at cash flows in 3 separate categories. Let's define these 3 categories and understand where the information generally comes from. First, what do businesses do? They get money, they buy assets, they run the business. All companies do these 3 activities. By getting money, they finance the business, they sell stocks or bonds. Buying assets, they invest in productive assets, primarily purchasing property, plant, and equipment. And then they operate it to make a profit. These 3 activities form the basis of presentation of data in our cash flow statement. The financial statement wording is financing, investing, and operating. Now in the statement itself, they actually reverse that order. Operating first, investing second, and financing last. So why change the order? Well, it's probably because investors or potential investors want to focus on the results of operations currently. So the operating activities section is highlighted first. We're not telling the story of how a business began. That could have been years earlier, but how it's generating cash now from operations. Then, what's it now doing with that cash? That is it buying new productive assets to expand the economic engine? Or is it selling them off? Is it paying out dividends, what I call reverse financing? Or is it issuing bonds to get more cash? Okay, let's look at these 3 activities: operating activities, investing activities, and financing activities. That's exactly what they're called on the statement of cash flows: activities. So operating activities, cash is coming in or cash is going out, plus or minus. Investing activities, again, cash is coming in or going out, plus or minus. Likewise, financing activities, cash is coming in when we sell stock, cash is going out when we redeem bonds. So we can have plus or minus amounts in each of these sections. It's important to realize that each section can either be a source of cash coming in or a use of cash going out. Furthermore, the details within each section could be plus or minus numbers, all representing, is there a net change in cash for the period? Plus, did net cash increase, or minus, did net cash during a period of time decrease? We can do cash flow statements for any period of time, a month, a quarter, or a total year. To that change in cash for the period, we simply add beginning cash to come up with ending cash balance in our balance sheet. This is the function of a cash flow statement. Where did cash come from? Where did it go to? What was the net change for the period? And what's the ending cash balance for that period? Now let me make an obvious statement. Positive numbers on this statement means that cash is coming in. Negative numbers means that cash is going out. As I mentioned earlier, in any one section, we can have cash going both ways in each section. Let's look at a very oversimplified example. Operating activities. $125,000 of cash coming in plus. Investing activities. $75,000 of cash used, a negative number. Financing activities, $50,000 plus cash coming in from various activities. What's the net total of all these three activities? $100,000 plus net cash increase during the period. So the net change in cash, an increase of $100,000 explained by three separate activities: operating, investing, financing activities. All you do is bring in the beginning cash balance, $15,000 in this case, as an example, and work down to a total ending cash balance, $115,000. Net change plus beginning balance. When we later prepare a cash flow statement, we'll see that most of our work is involved in the operating activities section. Let's talk briefly about where the data comes from. For our operating activities section, we'll start with net income. We'll modify it with certain adjustments, and then we'll bring in changes to current assets and current liabilities. For our investing activities section, we'll look at purchases of property, plant, and equipment and other long-term investments or sales of them. In other words, do we use cash by buying them or do we obtain cash by selling them? And lastly, financing activities. Did we sell stock or bonds to provide cash flowing in positively, or do we buy back stocks or bonds, a negative flow of cash in that section, or do we pay dividends, also a negative flow of cash? So to recap the three classifications: operating activities, investing activities, and financing activities. Each distinctive sections all totaling down to one change for the period. Operating activities start with net income and look at current assets and current liability changes during the period. Investing activities, changes in property, plant, and equipment, and other long-term assets. Financing activities, changes in long-term liabilities, such as bonds payable, and certain stockholder equity items. Now, to understand how we piece together a cash flow statement, we must understand the elements of a classified balance sheet. This was introduced back in Principles 1. What is a classified balance sheet? It's not simply a listing of all assets and all liabilities, but subtotals. That is, current assets versus long-lived assets, or current liabilities versus non-current liabilities in a stockholders' equity section. So a classified balance sheet simply segments our balance sheet into defined sections that make them more understandable for a reader and allows us to prepare a cash flow statement as well. Current assets, what are we talking about? Cash, accounts receivable, inventory, prepaids. These are items that are cash or turn into cash or are used up within 12 months. Long-lived assets, we're talking about land, building, equipment, and other investments. These are the items that a business operates on to produce revenue. Current liabilities, accounts payable, taxes payable, etc. Anything that's due within 12 months or within the operating cycle of the business if it's longer than 12 months. Non-current liabilities, bonds payable, notes payable. Items due beyond 12 months or beyond the normal operating cycle of the business. Stockholders' equity, stock, retained earnings, treasury stock. These classifications on our balance sheet represent 90% of the raw material to do a cash flow statement. Now, let's not forget that a cash flow statement is concerned about changes in cash, a very important asset in the balance sheet. However, to develop our changes in cash during the period, we're looking at all the other elements of the balance sheet to determine that change in cash. If our balance sheet really balances, and it must, if we look at all the changes in the other accounts other than cash, they'll come back to that change in the cash balance. So the net changes to all other balance sheet accounts will equal a change to the cash account only. So we're going to concentrate on changes to receivables, inventories, property, plant, and equipment, payables, bonds payable, in the equity section. That will give us, as mentioned, 90% of the raw material to do our cash flow statement. Let's get a perspective. Here's two balance sheets, comparative balance sheets, 2013, 2014, and their changes in the last column. It's the last column that gives us our ingredients for doing the cash flow statement. Here we see cash has increased by $22,000 from $33,000 to $55,000 at the end of 2014. It's that $22,000 change or increase that we're explaining in our cash flow statement. We'll do that by looking at changes in all the other accounts as indicated. That includes the other side of the balance sheet, liabilities, stockholders' equity. If we account for those changes, we'll come back to a $22,000 increase in cash on our cash flow statement. Let me show you the details of the cash flow statement. First, look at that $22,000 increase to cash. That's what we're explaining. That's the bottom line of our analysis section on a cash flow statement, that change in net increase in cash, $22,000. With quite a bit of detail to explain that, though, as we see above. The only item that's missing on the bottom, we simply bring in our beginning cash balance and develop an ending cash balance. Simply arithmetic at the bottom. Now, this is a very busy looking statement, but you can see the three sections that we talked about. An operating section, operating activities, in this case net cash provided by operating activities, $170,000 positive. Investing activities, net cash used, $141,000, it's negative. And net cash used by financing, $9,000 negative. Those three sections total a change in cash of $22,000 increase for the period. The work involved in the statement is getting all the details, all the lines correct. To remove the detail to see the overall, here's a generic statement of cash flow. Again, the three sections, coming down to a net change for the period, plus beginning cash, developing ending cash. This generic overview allows you to see that the single net change in cash comes from three distinct sections. In the actual statement, the information is contained in the details. It's the details that tell readers how the company was managed during the period. Now, the format of the cash flow statement, there are two separate methods, a direct method and indirect method. We'll be concentrating on the indirect method in this course. The difference in the two methods only affects the presentation of the operating activities section of the report. The other two sections are identical under both methods. There are three sources of information needed to prepare a cash flow statement: comparative balance sheets, the net income statement, and additional information. Without getting into details yet, we already began to see that most of the information comes from changes in balance sheet amounts. 90% of our data for the statement comes from comparative balance sheets, two separate balance sheets. In the current income section, we'll start with the bottom line net income for the period, then modify it to get a cash basis only section. Plus, we'll need additional information such as dividends paid, etc.